All right, well, let's start with a look at what's happening in Toronto, where we just saw the Canadian market hit another intraday all-time high, the new record at 22,380. And of course, we've been talking about how the stock market rally in North America has been broadening out. This morning, we've got materials and financials helping out. The year-to-date performance, though, also tells us the story of what's been happening in Toronto, where you've had energy as a group up more than 15%, materials double-digit gain, industrials a double-digit gain. Let's get some more perspective on what's been happening in the markets. Joining us now, Mike O'Rourke, Chief Market Strategist with JonesTrading. Mike, great to have you with us. What do you make of the fact that what started as a big rally in tech has increasingly been extending to other sectors of the stock market?
Yeah, I actually think the tech portion of the rally is getting a little tired here. And as you know, people are going elsewhere. I think the inflation theme is reemerging, or at least from an investor standpoint. So that's why you're seeing gold act well, you're seeing oil act better. And I think there's a little bit of fear that the things that were, the major S&P rally was, the tech rally was predicated on, are starting to fade a little bit.
Let's take a look at gold if we can right now, which continues to hit these record highs. So walk us through your thesis. You gave us some of it on what you think has been driving that interest in bullion, which subsequently has driven a lot of interest in stocks tied to that trade, material sector stocks, et cetera.
So I think the gold rally actually started with Bitcoin, because Bitcoin went on an incredible tear and gold went with it as a competitive asset. But I think you're seeing this transformation in the market mindset, with the inflation data we've had in the U.S. the first couple of months of the year. Obviously, we have this big CPI report tomorrow morning. And then you have comments like the comments from Jamie Dimon from JP Morgan yesterday, just worried about inflation being a little more persistent out there. And then, in addition to that, you have, the conflict in the Middle East is starting to push oil prices up. So, this morning we had the NFIB survey where small business owners in the United States are very concerned about inflation. So you're seeing that theme grow again. And I think while gold is hitting all-time highs, it has lagged things like Bitcoin where it competes. And of course, it's been unloved relative to U.S. technology. So I think that's why people are looking elsewhere.
We are going to get some more inflation numbers in the U.S. tomorrow. We've also got a Bank of Canada interest rate decision, and every day the market is trying to predict what happens with the Fed on interest rates going forward based on the inflation trends right now. What's your current view on what happens in the U.S. this year?
So it's interesting. When Chairman Powell spoke on Good Friday at the San Francisco Fed, he said that, that confidence he wants would be, a series of readings similar to we had in the second half of the year of last year in 2023, which would be about core PC, the 3 to 6 month, annualized rates running at 2%. We're running probably closer to 4% right now. So even if we have a good number tomorrow, I think it's hard for that to get down to that 2% level by the June meeting, which is where expectations have been. So I think you have to back off the expectation of 3 rate cuts this year. And, I would say we're probably more in the camp of 1, but I know the Fed would like to ease. So I'll put it at 2 because that's where their bias is. But right now, the data isn't, especially, think about the strong jobs report we just received on Friday. The data isn't supportive of the Fed cutting rates in the immediate future.
Right. And we had a weaker than expected jobs report in Canada, and the Bank of Canada obviously is going to be watching what the Fed does as well. So highlighting the differences between the two economies right now. However, how much of a possible shift in expectations do you think is priced into the market? Like if we were to have a scenario, let's just use this as an example. Let's say there's 1 rate cut by the Fed this year. You just put that out there. Is the stock market, would it need to adjust, do you think, to that?
Oh, I think it would. We're at the point where the 10-year Treasury yield is higher than the S&P 500 earnings yield, first time in a couple of decades. I mean, that was an environment that was persistent in the 90s as, inflation was continually coming down and treasuries were just slow to rally behind it. So I think this market has pretty high expectations that the data is going to break in the right direction. A lot of that is because, the Fed stopped raising rates last summer, and by the fall, they were talking about cutting rates again. I think that that optimism got built into this tape, and we it's clear the Fed's bias is they want to cut rates. They just haven't had the data that allows them to do it yet. So I think when the expectation shift emerges, you are going to have to see some type of re-rating in the equity market.
And we're almost out of time, Mike, but you talked about the 10-year Treasury yield exceeding the S&P 500 earnings yield. Just walk us through why that is significant to you.
Well, it's important because obviously, a 10-year Treasury is a risk-free investment. And if you invest in the equity market, there's a lot more volatility tied to that. So with the S&P 500 earnings yield about 4.3%, I think that's about 23 and a half times earnings. That's, it's an expensive historical equity tape, and that's a relatively attractive Treasury yield. And as they compete for assets, if the 10-year yield continues to rise here, people should vie for the safer or quote unquote riskless asset as opposed to the risky asset, or the risky asset should have to reprice to become more attractive again. So I think that's an important relationship to watch going forward here.